Okay, welcome back. 2 minutes to go for the pre-open session. We talk about the US inflation numbers and how that's sort of trending lower. But here in India, we got a bit of a slight surprise as compared to market expectations. Indian June CPI came in higher than the CNBC-TV18 poll. The number was 4.94%. The actual number was over 5%. My colleague Latha is joining in. Latha, does this justify the need for a slightly hawkish RBI?
Well, the Reserve Bank governor did indicate hawkishness, and I think perhaps they had some preview, some idea that the June inflation is going to be a bit nastier than people are prepared for. 5.1, our expectation was, our poll was 4.94, but on the street there were even polls of 4.8 actually. So 5.1 quite clearly is a surprise. It's a 4-month high if you want to look at trends. But the culprits, largely vegetables, 14% higher month on month. Shouldn't come as a surprise to any of us. We've all paid 120 rupees for tomatoes at least, if not more. The prices of onions, potatoes also higher. So 14% month on month and 29% year on year. It would be okay if this were the only culprit because this is a normal monsoon affair. But pulses and cereals are also higher, both month on month and year on year. And I must particularly point out pulses 16% up year on year. Cereals have a very big weight, and that's nearly 9% up year on year. So all this has made the food inflation up about 9.3, if I'm not mistaken, up year on year. And that compares with an already high 8.69 in May. One was expecting it to recede after the hot summer months, but if anything, food inflation has gone up. Now, core inflation has come in at 3.1. It's marginally higher if you in decimal point version compared to what it was in May, but it is going to get a little worse, which is not bad. I mean, you don't want core inflation to fall too much because it shows that there is no demand. But it's going to go higher because of telecom tariffs. That's not entirely, absorbed in the June inflation, but it will come in the July inflation. Some 15 basis points is the impact on the entire CPI, according to economists. Now, what this has done is it's made most brokerages, like especially Citi and ICICI Securities, PD, say that there are no rate cuts at all in 2024. And more, there are more brokerages as well. I just picked up two. The point is the bond markets may not be terribly upset with this because the governor, when he spoke to CNBC-TV18, clearly said that not just rate cut, but even talk of stance change is too premature at this point in time. So bond markets were kind of expecting this. However, bond yields will continue to react to the US yields, and that clearly distinctly lower, even lower than 4.2. So actually, all told, this is going to be very good for banks. See, banks don't like a cut in the repo because immediately all loans linked to the repo fall. But deposits fall slowly because as they reprice, term deposits. So banks are losers when there is a repo cut. However, they gain when bond yields fall because they get mark-to-market gains. So the net, this is actually a little bit of positive for banking stocks. Coming to IIP, actually, that's a good number. 5.9, it's like some 6-month high. And I'll tell you what is good about it. The good part, of course, electricity has been doing well in such a summer. What else would you expect? 13.7% higher, but manufacturing also is 4.6, and that's supported by consumption. That's what we were ruining. Consumption is not doing well in India. It's all government capex. Look at the consumer durables, 12.3. I guess a large part of it is air conditioners. And consumer non-durables, which was negative in April, has become a positive, which means probably there is a rural recovery. So I would say both these numbers are positive.
Okay, both these numbers are positive. Got that. Thanks a lot, Latha, for joining in and explaining the macros to us.